Viewers at home, you are welcome to my presentation on capital allowance. In this presentation, I will examine the meaning of capital allowance, types of capital allowance, features of each of the types, then the formula for calculating capital allowance. I will also provide a standard work example. If you are just joining me in this channel for the first time, or if you have not subscribed in the past, please click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. What is a capital allowance? Capital allowance is an allowance granted to a taxpayer in lieu of depreciation, which is treated as non-allowable expenses for tax purpose. It is granted in lieu of depreciation, as I've said, instead of financial accounting depreciation. Depreciation is not allowable for tax purpose. So capital allowance is granted in place of accounting depreciation. Types of capital allowance. Types of capital allowances. Number one, we have initial allowance. Initial allowance is granted to the taxpayer in the first basis period in which the qualifying capital expenditure is incurred. Initial allowance is granted to the taxpayer in the first basis period in which the qualifying capital expenditure is incurred. What are therefore the features of initial allowance? Features of initial allowance. It is claimable once throughout the life of the asset. Initial allowance is claimable once throughout the life of the asset. You can only claim it once. Number two, it should never be prorated. We don't use to prorate the initial allowance. Even when the number of months in a basis period is less than 12 months, which usually occur during commencement of trade or business. Even during the commencement, where the number of months in the basis period is less than 12 months, then you will still claim your initial allowance in full. You don't apply time apportionment to initial allowance. So it should never be prorated. That is, you can claim it in full. It should be claimed in full. Number three, it is determined by applying the initial allowance rate on the cost of the asset. To calculate the initial allowance, just apply the initial allowance rate on the cost of the asset. Suppose the cost of the asset is 1 million naira and the initial allowance rate is 50%. Therefore, initial allowance will be 50% of the cost, which is 1 million. So that will give us 500,000 naira. So that is initial allowance. It should never be prorated. Number two, we have annual allowance. Annual allowance. As the name implies, annual means yearly. Annual allowance is granted on the residue of the qualifying capital expenditure incurred after deducting the initial allowance. Annual allowance is granted on the residue of the qualifying capital expenditure after deducting the initial allowance. That is, annual allowance equal to cost minus initial allowance over estimated useful life of the asset. To get the estimated useful life of the asset, you apply 100 divided by annual allowance rate. 100 divided by annual allowance rate will give you the life of the asset. Where the annual allowance rate, where it is 25%, to calculate the estimated useful life of the asset, you have 100 divided by 25. That means such asset is expected to last for 4 years. It is expected to last for 4 years. What are the features of annual allowance? Features of annual allowance. Number one, it is calculated on straight line basis. Annual allowance is calculated on a straight line basis. Number two, it can be prorated. That is, you can apply time apportionment to annual allowance, where the number of months in the basis period is less than 12 months, then you can apply time apportionment to your annual allowance. So it can be prorated. Number three is investment allowance. Investment allowance. Investment allowance, this is granted to the business that incur the qualifying capital expenditure on plant and machinery. Investment allowance is granted to the business that incur the qualifying capital expenditure on plant and machinery. That means you can only claim the investment allowance on plant and machinery. So you can only claim it. And the rate, investment allowance rate, is 10%. Investment allowance rate is 10% of the cost of the plant and machinery. Features of investment allowance. Features of investment allowance. Number one feature, it cannot be prorated. Investment allowance cannot be prorated. That means you cannot apply time apportionment to investment allowance. So it should be claimed or granted in full. Number two, it is granted at the rate of 10%. I've told you earlier that the investment allowance rate is 10%. That is one of the features of investment allowance. Number three, it is granted only once in the life of the asset. You can only grant investment allowance once throughout the life of the asset. What are the conditions for granting capital allowance? Conditions for granting capital allowance. Condition for granting capital allowance. Number one condition, capital expenditure must have been incurred in the basis period. Capital expenditure must have been incurred in the basis period. Number two condition, its qualifying capital expenditure must be used. The qualifying capital expenditure must be used for business purpose. The qualifying capital expenditure must be used for the purpose of the business. Number three condition for granting capital allowance, assets must be used. Assets must be in use at the end of the basis period. The qualifying capital expenditure, that is that asset, must be in use at the end of the basis period. Restriction on capital allowances. I want you to know that capital allowance claimable in any year of assessment should not be more than or should not be greater than 66/2/3% of the assessable profit. 66/2/3% is equivalent to 2/3 of assessable profit. The amount of capital allowance you can claim in any year of assessment should not be greater than 2/3 of the assessable profit. There is an exception to the restriction for an agro-allied company or manufacturing company, there is no restriction on their capital allowance. Agro-allied farming or agricultural companies, no restriction on their capital allowance. Then capital allowance carried back. Capital allowance carried back. Capital allowance carried back. On cessation of trade or business, the unclaimed capital allowance may be carried back for relief against total profit of 5 years of assessment preceding the year of cessation. During cessation of trade or business, the unclaimed capital allowance may be carried back for relief against total profits of 5 years of assessment preceding the year of cessation. Classification of companies. Classification of companies. In accordance with Finance Act 2019. Finance Act 2019. Finance Act 2019 classify companies into 3 types of companies in accordance with Finance Act 2019. I've told you that Finance Act 2019 classify companies into 3. We have small companies, we have medium-sized company, medium-sized company, and we also have large companies. Then, in accordance with 2019 Finance Act, each of the companies have the following characteristics. A small company is a company with annual turnover of less than or equal to 25 million naira. Any company with annual turnover of less than or equal to 25 million naira is said to be a small company. Then a medium-sized company is a company with an annual turnover of greater than 25 million naira but less than 100 million naira. So then we also have large company in accordance with 2019 Finance Act. Large company is a company with an annual turnover of greater than or equal to 100 million naira. Then the following are their applicable tax rate. For a small company, the tax rate is 0%. For medium-sized company, the tax rate is 20%. And for large company, the tax rate is 30%. I want you to know that no capital allowance should be claimed for a small company. I've told you that any company with an annual turnover of less than or equal to 25 million is said to be a medium-sized company. I mean, a small company rather. No capital allowance is claimable for such a company. Then, if you say turnover, I want you to know that turnover is the same as revenue. Turnover is the same as revenue. Capital allowance rate. Initial allowance in percentage. Annual allowance percent. We have building, industrial and non-industrial building. We have 15% and 10% for initial allowance and annual allowance respectively. We have mining. Initial allowance 95%, annual allowance rate is nil. Plant, that is agri production, initial allowance is 15%, 95%, annual allowance is nil. Other plants, we have initial allowance 50% and annual allowance 25%. Furnitures and fittings, initial allowance 25%, annual allowance is 20%. Motor vehicles for public transportation, Initial allowance is 95%, annual allowance is nil. Then motor vehicles, other motor vehicles, initial allowance 50%, annual allowance 25%. Plantation equipment, initial allowance 95%, annual allowance nil. Housing estate, initial allowance 50%, annual allowance 25%. Ranching and plantation, initial allowance 30%, annual allowance 50%. Research and development, initial allowance 95%, annual allowance is nil. So these are the capital allowance rate. Now I want to take a work example. Example: Big City Enterprises Limited. It's a trading company located in Lokoja, Kogi State of Nigeria. It commenced trading on January 1, 2020 and makes up its accounts to June 30 every year. For tax purposes, the adjusted profits of its first 2 years of operations are as follows, amounting 1,000 naira. January 1, 2020 to June 30, 2020, 8.5 million naira. July 1st, 2020 to June 30, 2021, 22.4 million naira. It acquired property, plant and equipment as follows: date, asset purchase and cost. January 2, 2020, motor vehicles, 8.4 million naira. April 1st, 2020, office equipment, 2.3 million naira. September 7, 2020, furniture and fittings, 1.2 million naira. The company achieved a revenue of 26 million naira for the first 6 months after commencement of business. Due to favorable climate, its revenue increased to 102 million naira in the year ended June 30, 2021. Required: 1. Determine the basis period of assessment and capital allowances. 2. Compute the income tax payable for the relevant assessment years. Ignore minimum tax computation. So this question is obtained from Taxation, ICAN, May 2022. So now let's have the solution. Solution, I think May 2020 and November 2022. So we have Big City Enterprises Limited. That is the name of the entity. Big City Enterprises Limited. In the first requirement, you have to determine the basis period of assessment and capital allowance. So, determination of basis period of assessment and capital allowance. So we have year of assessment, then basis period. Now let's also have assessable profit. Assessable profit. There is no overlapping or coincidental period in finance art. If you have watched my earlier presentation on commencement principle, I've told you that the core principle of finance art is preceding year basis. Preceding year basis is the core principle. Now let's go through the question. It's commenced business. The business commenced trading on 1st of January 2020. January 2020. And the account was prepared to June 30, 2020. If the core principle is preceding year basis, PYB, that means the first year of assessment will not be 2020, so it will be 2021. The profit for 2020 year of assessment will be assessed in 2021. So the first year of assessment is 2020, and the basis period will be 1st of January 2020 to 30th of June 2020. So year of assessment 2021. Basis period 1st of January 2020 to 30th of June 2020. Now, for the said period, the assessable profit is 8.5 million naira. So 8.5 million naira. That is the profit that will be assessed in the first year of assessment. 8.5 million naira. The second year of assessment will be 2022. In line with the Finance Act, we said the basis period for the second year of assessment will be the basis period commencing after the accounting period just ended. You know, the accounting period for 2021 ended as at June 30, 2020. So that means it will start from 1st of July, since this ended as at June. 1st of July 2020, where this one end, to the end of the second accounting period. The second accounting period ends when? So July 1st, 2020 to June 30, 2021. That is the second accounting period. 1st of July 2020 to 30th of June 2021. And the assessable profit for that period is 22.4 million naira. 22.4 million naira. So this is the assessable profit for the first 2 years of assessment. Now, what are the qualifying capital expenditure? Qualifying capital expenditure. You look at the date of acquisition. Any asset acquired between this period, meaning that it will qualify in 2021 year of assessment. And if there are assets that have been acquired prior to this period, meaning that before January 2020, if you have an asset acquired in 2029 before the business commenced, that means the asset will be assumed to have been acquired in 2021. So the year that such asset will qualify will be 2021 year of assessment. If you have an asset acquired prior to this period, you assume it will qualify in 2021 year of assessment. So what are the assets acquired between January 2020 to June 2020? Now let's look at the acquisition. The first one, January 2nd, motor vehicle was acquired for 8.4 million. So we have motor vehicle, it qualifies in 2021 year of assessment. This was also acquired in April 2020. That is office equipment. So that means it's also qualified in 2021 year of assessment. Office equipment. These two assets qualified in 2021 year of assessment. Now, the third asset is furniture and fittings, which was acquired in September 7, 2020. You know, the accounting period, this business period ended as at 30th of June. That means it doesn't fall within this period. September 2020 will fall in 2022 year of assessment. Since the basis period for 2022 year of assessment must have commenced from 1st of July 2020 to June 30, 2021. And the asset acquired in September 2020. September 2020 is in between this period, since this period have commenced from July 2020. July 2020, after July we have August, then we have September. An asset was acquired in September 2020. So asset acquired in September 2020 qualifies in 2022 year of assessment. Therefore, we have furniture and fittings. Furniture and fittings. So these are the qualifying capital expenditure. I've told you that there is nothing like overlapping or coincidental period. And prior to the commencement of Finance Act, so we used to have overlapping or coincidental period. So meaning that If the question you are given, if it is not in line with Finance Act, so you could have a period that will overlap, and where periods overlap, then that means the qualifying capital expenditure will be treated in earlier basic period. So I will still solve a question, I will still make a video on capital allowance prior to the commencement of Finance Act 2020. So now let's have the second requirement. We've done with the requirement 1. Requirement 2, you have to compute the income tax payable for the relevant assessment years. You want to compute the income tax payable for the relevant assessment year. The relevant assessment year are 2021 and 2022 years of assessment. So computation of income tax payable for 2021 and 2022 years of assessment. Please, the year of assessment is different from the accounting period. Therefore, it will be wrong for you to put computation of income tax payable for 2021 and 2022 accounting year. It is wrong. So, and aside that, if you put 2020 and 2021, you've scored 0. So please be careful in your use of the years in the question. The years must be stated, the year of assessment. And in question, the question will say for relevant years of assessment. It is wrong for you to put for relevant years of assessment. If you put for relevant years of assessment, you've equally scored 0. Please watch out for all this. Now, we have year of assessment. The first year of assessment is 2021. We have assessable profit. Assessable profit. The assessable profit for 2021 amounted to 8.5 million naira. 8.5 million naira. Then you now have your capital allowance. Capital allowance for the year. Let's have the computation of capital allowance for big city. Computation of capital allowances for 2021 and 2022 years of assessment. Now, the qualified capital expenditure include, we have motor vehicle 8.4 million. Motor vehicle. Then we also have office equipment and furniture and fittings. Office equipment. We have furniture and fittings. So we have initial allowance rate and the annual allowance. For motor vehicle, initial allowance is 50%, annual allowance is 25%. For office equipment, initial allowance is 50%, annual allowance is 25%. For furniture and fittings, initial allowance rate is 25%, while annual allowance rate is 20%. So, year of assessment 2021. I've told you that only 2 of the assets qualifies in 2021 year of assessment. The 2 assets that qualifies are motor vehicles and office equipment. These 2 qualifies in 2021 year of assessment since they were acquired in part of 2021 basis period. Remember, the basis period for 2021 year of assessment in requirement 1 is from January 1, 2020 to 30th of June 2020. So, and the assets were acquired between the said period. So we have cost. The cost of motor vehicle that was acquired is 8.4 million, while that of office equipment is 2.3 million. 8.4 million and 2.3 million naira. Then we have initial allowance. I told you that to compute the initial allowance, you apply the initial allowance rate on the cost of the asset. 50% of 8.4 million, that will be 4.2 million. 4.2 million. 50% of 2.3 million will be 1,150,000. Then we also have annual allowance. Remember, since the basis period for 2021 year of assessment spanned from January 2020 to June 2020, which is 6 months. Therefore, we are going to apply time apportionment to annual allowance. That is, annual allowance should be prorated. So we have 6 months, January to June. So we have annual allowance for 6 months. That is what you need. And I've told you that to compute the annual allowance, you have the cost minus initial allowance divided by the estimated useful life of the asset. The annual allowance rate is 25%. Therefore, the useful life of the asset, I've told you that to get the life of the asset, we have 100 over the annual allowance rate, which is 25%. So that means the asset is expected to last for 4 years. Therefore, to compute the annual allowance, the first asset is motor vehicle. Motor vehicle, full year annual allowance. Full year. The cost of motor vehicle is 8.4 million. And the initial allowance is 4.2 million. So we have 8.4 million minus 4.2 million. So we have 8.4 million minus 4.2 million divided by the life of 4 years. So 8.4 million minus 4.2 million divided by 4. Therefore, annual allowance on motor vehicle for full year is 1,050,000. 1,050,000. That is annual allowance. That is for full year. And what you need is 6 months. Since the number of months in the basis period is 6 months, so the annual allowance for 6 months now will be full year annual allowance of 1,050,000 times 6 divided by 12. 6 months out of 12 months in a year. So we have 525,000. So the annual allowance of motor vehicle for 6 months will be 525,000. Therefore, that of office equipment, the annual allowance rate is still 25%. That means office equipment is expected to last for 4 years. So we have cost. The cost is 2.3 million minus initial allowance of 1,150,000. So full year annual allowance, full year, which is cost of 2.3 million minus 1,150,000, which is the initial allowance, divided by the useful life of 4 years. That will give us 287,500. This is the annual allowance for full year, that is for 12 months. Therefore, annual allowance for 6 months now. 6 months will be 287,500, which is full year annual allowance, times 6 months out of 12 months in a year. Times 6 divided by 12. That gives us 143,750. So that is the annual allowance for 6 months. So annual allowance for motor vehicle for 6 months is 525,000 as calculated. Annual allowance for office equipment for 6 months as calculated is 143,750. So how much is the total initial allowance? 4.2 million plus 1,150,000. That gives us 5,350,000. 5,350,000. Then annual allowance 525,000 plus 143,750, and that is totaled 668,668,750. So if you sum it up, plus 5,350,000, then you have 6,018,750. That means capital allowance for the year is 6,018,750. Then after that, you have 2022 year of assessment, where you are going to have tax written down value. Tax written down value 8.4 million minus 4.2 million minus 525,000. Then you have 3,675,000. Then for office equipment, 2.3 million minus 1,150,000 minus 143,750. We have 1,006,250. Then in 2022 year of assessment, furniture and fittings qualifies, and the cost is 1.2 million. So since it is not an addition to the existing asset, you don't need to put addition, so you put cost. So we have cost of a new asset. But if another motor vehicle qualifies in 2022 year of assessment, then you put addition. So there is no addition to motor vehicle, no addition to office equipment, but we have cost of furniture and fittings of 1.2 million. 1.2 million. Then we have initial allowance. Initial allowance rates on office equipment, on furniture and fittings is 25%. So you have 25% of 1.2 million. That gives us 300,000. Remember, I told you earlier that initial allowance is a once and for all grant, and it is not prorated. That means initial allowance can only be claimed once throughout the life of the asset. Since you have claimed initial allowance on the existing asset of motor vehicle and office equipment, then no further initial allowance will be claimed on those existing assets. You only claim initial allowance on the new assets. So we have annual allowance. Annual allowance. You will claim annual allowance on the existing assets. You are going to claim it in full in 2022 year of assessments, since the number of months in the basis period of 2022 year of assessment is up to 12 months. Remember, this one was not up to 12 months. That is why we calculated our annual allowance based on 6 months. Because the number of months in the first year basis period was given to the 6 months. Now we have 12 months. So you claim annual allowance in full on the existing assets. So annual allowance for full year on motor vehicle, how much is that? Motor vehicle full year annual allowance is 1,050,000. 1,050,000. On office equipment, full year annual allowance on office equipment is 287,500. 287,500. Then you are left with furniture and fittings. You have not claimed annual allowance on furniture and fittings previously, so you are claiming that for the first time on that asset. Therefore, let's compute the number of life on furniture and fittings. Since the annual allowance rate on furniture and fittings is 20%, so we have 100 divided by 20. That means furniture and fittings is expected to last for 5 years. 5 years. Then annual allowance on furniture and fittings, we have cost. The cost of furniture and fittings is 1.2 million, and initial allowance is 300,000. So 1.2 million minus 300,000 over 4. So that gives us 225,000. You are going to claim annual allowance on furniture and fittings in full because the number of months in 2022 year of assessment is up to 12 months. So you claim the annual allowance in full, 225,000. How much is the total annual allowances? 1,050,000 plus 287,500 plus 225,000. Annual allowances is totaled 1,562,500. So now, if you add it to initial allowance, you have 1,862,500. That is the capital allowance for the year. Capital allowance for the year. Then we cannot compute the tax written down value on the assets. So for motor vehicle, we have 3,675,000 minus 1,050,000. Then we have the tax written down value. Tax written down value on motor vehicle to be 2,625,000. 625,000. Then on office equipment, we have 1,006,000 and 6,250 minus 287,500. Then we have the tax written down value of 718,750. On the furniture and fittings, 1.2 million minus 300,000 minus 225,000. Then we have 675,000. Now, capital allowance for the year. The capital allowance for 2021 year of assessment as computed is 6,018,750. 6,018,750. If you calculate 2/3 of our assessable profit, capital allowance claimable in any year of assessment shall be restricted to 66 over 3% of the total assessable profit. which is equivalent to 2/3 of the assessable profit. Now let's calculate 2/3 of our assessable profit. Assessable profit of 8.5 million. 2/3 of that gives us 5,666,667, which is lower than this. That means if 2/3 of the assessable profit is greater than 6,018,750, that means the 6,018,750 will be claimed in full. But since 2/3 of the assessable profit of 8.5 million is lower than the capital allowance, that means our capital allowance will be restricted to 2/3 of the assessable profit. So capital allowance restriction, or let me say capital allowance claimed, which is 2/3 of the assessable profit of 8.5 million. That gives us 5,666,667. I've told you that we are restricting it to this because this 2/3, the 2/3 of our accessible profit is lower than the capital allowance. So you are claiming 5,666,667. That means the unclaimed capital allowance, which is the difference between this and this, the difference is 352,083. 352,083. The unclaimed capital allowance will be carried forward. So we have capital allowance carried forward. Now, capital allowance carried forward. So, now how much will that be the total profit? Total profit. Our total profit will be 8.5 million minus 5,666,667. 8.5 million minus 5,666,667. Then we have the total profit to be 2,833,333. So this is total profit. Then we now have to calculate compute income tax payable. So income tax payable. I've told you that the classification of companies based on Finance Act 2019. I've told you that Finance Act 2019 categorized companies into three. You have the small companies, you have the medium-sized company, and we have large company. The company whose annual turnover, if it doesn't exceed 25 million, we say it is small company, and that will be taxable at 0%. But the company with annual turnover of greater than 25 million but less than 100 million, so will be taxed at the lower rate of 20%. Now look at this company. The company achieved a revenue of 26 million for the first 6 months. Revenue of 26 million is greater than 25 million. Since it is greater than 25 million but it is less than 100 million, therefore we are going to use lower rate of 20%. So that means the company is said to be a medium-sized company in 2021 year of assessment. So we use lower rate of 20%. 20% of our total profit of 2 million. 833,333. 20% of that gives us 566,667. Then the tertiary education tax. Tertiary education tax. Education tax, which is 2% of assessable profit. This is our assessable profit, which is 8.5 million. If you compute 2% of 8.5 million, that gives us 170,000. That means the tertiary education tax will be 170,000. That is for 2021 year of assessment. Then in 2022 year of assessment, 2022 year of assessment, 2022, we have the assessable profit. Assessable profit for 2022 year of assessment, profit of 22.4 million naira. 22.4 million naira is our assessable profit. 22,400,000. Then we have capital allowance for the year. For 2022 year of assessment, capital allowance amounted to 1,862,500. 1,862,500. Then the unclaimed capital allowance for the prior year will be brought forward. So we have capital allowance brought forward of 352,083. If you sum it up, 1,862,500 plus 352,083. That gives us 2,214,583. If you calculate 2/3 of our assessable profit, it will be greater than the capital allowance. That means capital allowance will be claimed in full. Capital allowance claimed. 2,214,583. 2,214,583. Capital allowance carried forward will be nil since the capital allowance has been claimed in full. Therefore, our total profit amounted to, if you deduct the capital allowance from the assessable profit, minus 22,400,000. Then we have 20,185,417. That is our total profit. Then income tax payable. For 2022 year of assessment, back to the question. You were told, due to favorable business climate, its revenue increased to 102 million naira in year ended June 30, 2021, which is part of 2022 year of assessment. Since revenue is greater than 100 million, so we are going to use the normal income tax rate of 30% in 2022 year of assessment. So we have 30 tax payable at 30% now of total profit, which amounted to 6,055,625. So tertiary education tax, which is 2% of assessable profit. Our assessable profit is 22.4 million. 2% of 22.4 million. That gives us 448,000. 448,000. So this is the end of the solution to the question. Please don't forget to share the videos with others. God bless you as you share it with others. Thanks.